Hey everybody, it's me again, your girl Toyiah Marquis, checking in for gumbumper.com, the entertainment news website. Well, we're doing something a little different here. Like I told you guys before, we're talking about starting your own business and entrepreneurship. Thank you guys for checking out my video last week, and I appreciate the comments and the emails that I got regarding that video. Today I'm going to be talking about legal structure for your business and choosing a structure for your business. I got a lot of emails of people saying that they wanted to start their own business, but they didn't know where to start. So I do have some notes here because I will be glancing down at my notes. These are my own notes. There's a lot to cover, so that's why I actually created notes to make sure I'm giving you guys all the best information that you can use. Okay, and hopefully somebody takes this information and they go out and create their dream. So the basic structure for creating a business is a sole proprietorship. Basically, that's the most basic form and the most basic type of business to establish. So if you own a blog, or if you're a freelance writer, or let's say a dancer or something like that, and you're getting paid, you're pretty much a sole proprietor. Basically, you own the company, you handle all the taxes and the liabilities and everything that comes along with that. You do not have to take any formal action to form your sole proprietorship. As long as you are the only owner, this status automatically comes when you form and you start your business activities. In fact, you may already own one without even knowing it. But like all businesses, you need to obtain the necessary licenses and permits. Different states have different they all have different regulations, and it varies, based on the industry, state, and locality. I'll tell you guys the advantages and disadvantages of having a sole proprietorship. The advantages are it's easy and inexpensive to form. So it's the most simplest and least expensive business that you can establish. The costs are minimal, with legal costs limited to obtaining the necessary licenses and permits. You have complete control because you are the sole owner of the business. You have complete control over all the decisions. You aren't required to consult with anyone, and you can make your own decisions. It's easy for tax preparation because your business is not taxed separately. It's easy to fulfill the tax reporting requirements for a sole proprietor. The tax rates are also the lowest of the business structures. The disadvantages of having your own sole proprietorship is unlimited personal liability. If someone sued your business, those implications will come to you because you do not have any what they call a corporate veil or anything protecting your assets. So you will be totally liable for anything that occurs within your business. The debts, any obligations, or anything like that is going to fall on you. And it's hard to raise money as a sole proprietor. You often face the challenges when trying to raise money because you can't sell any stock in the business, and investors don't want to invest in sole proprietors because it's like they'll be giving the money to you directly. Banks are also hesitant to lend money to sole proprietors because of the lack of credibility when it comes to repayment of the loan. So that is, my friend, the sole proprietorship structure of a business. All right. Then we're going to start with LLCs. LLC stands for Limited Liability Company. Okay? An LLC is designed to provide the limited liability features of a corporation and the tax efficiency and operational flexibility of a partnership. A limited liability company is a hybrid type of legal structure that provides limited liability features of a corporation and the tax efficiencies and operational flexibility of a partnership. The owners of an LLC are considered members. Depending on the state, the members can consist of an individual owner, which is one, two or more individuals, corporations, or other LLCs. So the advantages of an LLC is limited liability. That's the main advantage of owning an LLC. Your members are protected from personal liability for business decisions or actions of the company. This means that if the LLC incurs any debt or is sued, the members' personal assets will not be touched and is usually exempt. So this is similar to the liability protections afforded to shareholders of a corporation. Keep in mind that a limited liability means limited liability. Members are not necessarily shielded from wrongful acts including those of their employees. You guys have less record keeping. An LLC, the operational ease is one of the greatest assets, one of the greatest advantages of having an LLC. Compared to S Corps, there's less registration paperwork and there are smaller startup costs. I think in the beginning, though, to form your LLC, it's one lump sum. Maybe, I know in Illinois it's like $500. I'm not sure for all the other states because I'm here in Illinois. But there is one large lump sum in the beginning. But as far as like annual reports and all that stuff goes, and all the other paperwork that you need to file with the corporation, you don't necessarily have to do that with an LLC. The disadvantages of an LLC is limited life. In many states, when a member leaves an LLC, the business is dissolved and the members must fulfill all the remaining paperwork, all the legal and business obligations to close the business. So that means if Jane Doe left, the other members have to go ahead and do, paperwork to kind of get her fully dissolved and away from the business. Then you have to file self-employment taxes. Members of an LLC are considered self-employed and they must pay a self-employment tax towards Medicare and Social Security. The entire net income of the LLC is subject to this tax. Okay? So in 1 minute, we'll come back and we'll talk about the other structures. So hopefully you guys are listening carefully and getting a pen and paper and writing this stuff down. Or you can just email me at celebjuice, that's CELEB juice, at gumbumper.com with questions or comments about how to structure your legal entity. Okay? We'll be right back. Hey guys, I hope that what I said in the beginning of the video was helpful to you guys. I hope that it can help someone, and I hope that it can put that fire under you to get started with creating your own business. The other structures that I want to talk about today are corporation. Basically, a corporation is the more complex type of structure, and it's suggested more for larger, more established companies with multiple employees. A corporation sometimes is also referred to as a C Corp. It's an independent legal entity owned by its shareholders. This means that the corporation itself, not the shareholders that own it, is held legally liable for the action and debts that the business incurs. Corporations are more complex than other business structures because they tend to have costly administrative fees, complex tax and legal requirements, meaning you got to have an accountant, you got to have a tax person, and you got to have a lawyer really to help you with your C Corp. Like I said, it's mostly for larger size businesses, like a Fortune 500 company or somebody with maybe more than 3 to 500 employees. So most people, you may not want to start out that big. I mean, I know everyone wants to grow, and I wish you guys all the best in your endeavors and everything. But I don't think a C Corp is, something that will be helpful to someone trying to freshly start out, owning and operating their own business. So I'm pretty much not going to go into a C Corp, but what I will do is talk about an S Corp. An S Corp is similar to a C Corp, but you're only taxed on the personal level, which most of my businesses that I have are S Corps. An S Corp sometimes is referred to as an S Corporation. It's a special type of corporation created through an IRS tax election, which is also the Form 2553 that you must file with the IRS to actually create that delegation. An eligible domestic corporation can avoid double taxation once to the corporation and then to the shareholders, which is normally done with a C Corp. That's not how it works. An S Corp is a corporation with a subchapter S delegation from the IRS, like I said. To be considered an S Corp, you must first charter a business as a corporation in the state where your business is headquartered. According to the IRS, the S Corps are considered by law to be a unique entity, separate and apart from those who own it. This limits the financial liability for which you, the owner, or your shareholders are responsible. Nevertheless, liability protection is limited. S corps do not necessarily shield all the business owners from litigation, such as employees' tort action or as a result as a workplace incident. What makes the S corp different, though, from a traditional C corp is that the profits and losses can be passed through to your personal taxes. So each member at the end of that tax year will get a Schedule K. And it will pretty much break down all of the expenses and everything for that business, and each person will get their Schedule K, and they will file that Schedule K with their own personal taxes. Okay, so that's how an S corp works. The advantages of an S corp is the tax savings. One of the best features is the tax savings for you and your business. While members of an LLC are subject to employment tax on the entire net income of the business, only the wages of the S corp shareholder who is an employee is subject to employment tax. The remaining income is paid to its owners by distribution, which is taxed at a lower rate, if anything. The business expense tax credits, the independent life, and S corp delegation also allows a business to have independent life separate from its shareholders. So meaning if a shareholder leaves the company or sells his or her shares, the S corp can continue to do business undisturbed. Maintaining the business is as distinct as a corporate entity. It's clear lines between the shareholders and the business that improve the protection for the shareholders. The disadvantages of an S corp are the stricter operational practices. As a separate structure, S corps require scheduled director and shareholder meetings. So you got to have a shareholder meeting, and you got to take meeting minutes once a year. And you must file these things once you do your annual report. Let's see. Partnerships. A partnership, they have several types of partnerships. Anytime you're doing business with more than one person, you are considered a partnership, unless you structure your business another way. There are several different types of partnerships which depend on the nature of the arrangement and the partner responsibility for the business. A partnership is a single business where two or more people share ownership. Like, for instance, with gumbumper.com, I share ownership with one other person. So her and I, we are partners, which we possess a partnership for this business. Each partner contributes to all aspects of the business, including money, property, labor, or skill. In return, each partner shares in the profits and losses of the business. Because partnerships, they entail more than one person in the decision-making process, it's important to discuss a wide variety of issues up front and develop a legal partnership agreement in the beginning. The types of partnerships, there are like three types of partnerships. You have a general partnership, a limited partnership, and a joint venture partnership. So the advantages is it's easy and inexpensive to create a partnership. You have shared financial commitment, so that's less burden on your pocket by yourself when you start up. And like different skills, you know, you may possess one thing and your partner may possess one thing, and you bring it together to create the whole. The incentives and stuff like that come with it. But there are some disadvantages of a partnership. Those disadvantages are the disagreements among the partners. If you and Jane Doe can't come to an agreement on something, it's going to be hard to kind of figure out what you need to do without getting a third party involved, maybe a lawyer or someone that is unbiased. The shared profits, because partnerships are jointly owned, each partner must share the success and the profits of the business with all the partners. So that's the partnership part of it. So I covered sole proprietorship, I covered S corps, I covered LLCs, and I covered C corps a little. So you take from that what you like, and then you can actually go to your Secretary of State in whatever state you're located and see, you know, what is needed and necessary for you to create your business. Like I said, if you have questions, you can also email me at celebjuice@gumupper.com, or you can leave your questions and comments at the bottom of this post. All right, I hope I helped someone out there, and I hope to see you guys, you know, starting these businesses, okay? Thank you so much. Again, I'm Toyiah Marquis, checking in from gumbumper.com, and I will see you guys next week where we talk about social media. Bye.